Welcome to the Explainer. I am absolutely thrilled you're here today. Look, for the past few sessions, we've been looking at the balance sheet, the P&L, and the cash flow statement as completely isolated documents, kind of like reading different chapters of a textbook. But today, we're changing gears entirely. Let's treat this like a real whiteboard session. We're taking those statements completely out of the textbook to see how they actually connect as one living, breathing system. Think of it like the engine room of a business. When one gear turns, the others literally have to respond. I'm going to be your guide for this. Think of me as your practical older brother, showing you how the actual mechanics of business work out in the real world, and more importantly, how to spot when the numbers are telling a completely different story.
But right before we start tearing down that engine, I want you to think about a company's bottom line. When you look at an income statement and you finally get down to that very last number, the net profit, where does it physically move to next? Because it doesn't just sit there on a piece of paper, right? It has to physically move somewhere. And following that exact movement is how the pros separate the real wealth creators from the companies that are just playing accounting games to artificially pump their stock price. Understanding that movement is the exact secret to unlocking how a business truly operates.
So here's our study plan. Section 1, we map the physical flows between the connecting statements. Section 2, we walk through TCS's FY24 financials. Section 3, we decode the new IND-AS rules. Section 4, we lock down interconnectivity ratios. And Section 5, we wrap up with your quick connection practice. Let's dive right in. Section 1, connecting the three statements. Okay, let's map out exactly how these distinct gears turn each other, starting with the absolute foundation of wealth creation. Watch where this number moves. The bottom line of your P&L is net profit, right? Well, after a company pays out its dividends, that remaining profit doesn't just disappear into the ether. It flows straight from the P&L into an account called retained earnings. And where does that sit? Right inside the equity section of the balance sheet. So every single year a company makes a profit and retains it, the equity on the balance sheet literally grows. This is the exact beautiful mechanism of compounding. When you see a stock chart going up over a decade, you are usually just watching the visual result of retained earnings compounding year after year to build intrinsic value. It's awesome. Let's move along and see how this builds with our second and third flows. Trace this line with me. That exact same net profit figure we just talked about, it is the literal starting point for your cash flow from operations. The cash flow statement builds right off the P&L's finish line. Now for the third flow, think about long-term investments, or CAPEX. When a company buys a massive new factory, that huge cash outflow shows up in the cash flow statement. That new factory then gets added as property, plant, and equipment over on the balance sheet. And over the next 10 years, it slowly depreciates, and that depreciation hits the P&L as a non-cash expense. It's a perfect continuous cycle. But honestly, this continuous cycle is also where cash gets trapped. A company can show a massive P&L profit, but if it's continuously sinking all of it back into heavy CAPEX just to survive against the competition, you will never see a single dime of actual free cash flow. And the final major connection we absolutely need to cover is working capital. Let's say a company sells a ton of product, but the customers haven't actually paid yet. Your receivables increase on the balance sheet. But over on the cash flow statement, you're going to immediately see a negative hit in your working capital adjustments. Why? Because the cash is stuck. You've booked the revenue, but you haven't seen the money. This is where things get real. The cash flow statement acts as the ultimate lie detector for the balance sheet. If management is trying to fool you by stuffing the channel and recognizing fake sales to hit quarterly targets, sure, the receivable will spike. But that negative working capital adjustment immediately triggers a massive red alarm on your cash flow statement.
Section 2. Walk through TCS FY24 financials.
Now that we have the blueprint of how these gears interlock, let's look at the machine in actual action. And we're going to use India's gold standard for clean accounts, Tata Consultancy Services, or TCS. Let's ground this in reality. In FY24, TCS generated a staggering net profit of roughly 46,000 crore rupees. Just take a second to let the sheer scale of that number sink in. But as we've learned, an isolated number is a dangerous thing in finance. We can't just take it at face value. We need to tear down the engine and see how that 46,000 crore was actually built, and more importantly, if it's completely real. When we look at their massive numbers across the board, the interconnectivity becomes vividly clear. They brought in 240,000 crores in revenue to get to that 46,000 crore profit. But look at the balance sheet efficiency here. They generated that massive profit using an equity base of only 90,000 crore and minimal debt of around 3,000 crore. That is an astonishingly high return on equity. Because they're consistently profitable and don't require heavy capital reinvestment just to keep the lights on, their retained earnings have built this absolute fortress without needing outside leverage. They just fund their own massive growth internally.
Now let's pull the ultimate thread, the cash flow. I want you to remember that 46,000 crore net profit. Take a look at their cash flow from operations. It's 47,000 crore. Here is the absolute beauty of this financial machine. Their operational cash perfectly mirrors their accounting profit. It's slightly higher due to non-cash add-backs like depreciation, but getting a near 1-to-1 ratio is the ultimate sign of high earnings quality. It means the profits sitting there on paper are actually translating into cold, hard cash in the bank. They aren't faking it with accounting loopholes.
Section 3. IND-AS, the new rules. Okay, those clean numbers from TCS are an absolute joy to analyze. But remember, financial statements aren't just objective math. They are built on strict accounting rules. And in India, that rulebook shifted massively. Listen to me, this is a classic amateur trap you need to avoid. Before 2016, Indian companies used a standard called Indian GAAP. But starting around 2016 and 2017, India fully shifted to the IND-AS framework, which is basically the Indian equivalent of international standards. So why does this matter to you? Because pre-2016 and post-2016 financials are completely non-comparable. If you run a 10-year automated screener crossing that 2016 boundary without manually adjusting for IND-AS, your data is fundamentally corrupted, and your analysis is going to be completely flawed. Let's look at a couple of the specific old versus new rules to see exactly why this breaks traditional screeners overnight. Under the old rules, a company might aggressively book revenue the second a product was delivered to the loading dock. Boom, booked. But under the new IND-AS 115, revenue is recognized strictly when the performance obligation is completely fulfilled. You can't just drop off a server and claim the cash if you still owe 3 years of mandatory maintenance. It decisively stopped tech and infrastructure companies from artificially front-loading their top line just to pump their quarterly numbers. It brought reality back to the income statement. And then there's IND-AS 1116 regarding leases. This was a massive shakeup. In the old days, operating leases basically just vanished into the P&L as a simple, mundane rent expense. Your balance sheet looked totally clean. Today, under IND-AS 1116, that simple rent expense is yanked out and hits your balance sheet as both a massive lease asset and a lease liability. Suddenly, companies that rented tons of retail space, think airlines or multiplex chains, looked like they had taken on massive debt overnight. The actual cash leaving the business didn't change at all, but suddenly their return on capital employed and debt-to-equity ratios were totally unrecognizable. The math was exactly the same, but the map we used to read the business completely changed. Section 4. Interconnectivity and key ratios. So, with the rules clearly understood, how do we actually measure the strength of these connections? We use ratios that specifically bridge the gap between statements. The most critical diagnostic for this is the cash conversion ratio, which tells us if a company's profit is a reality or a mirage. You calculate this by taking the cash flow from operations and dividing it by the net profit from the P&L. Remember TCS? They had 47,000 crore in CFO and 46,000 crore in profit. That gives them a ratio of about 1.02. A healthy range is anywhere from 0.9 to 1.1. A score near 1 proves that the P&L profit is actually converting into hard cash. If this number is consistently 0.3 or 0.4, run away. Management is legally lying to you. Notice a pattern here? The absolute most robust metrics in investing force you to pull the numerator from one statement and the denominator from another. Return on equity takes net profit from the P&L and divides it by equity from the balance sheet. Return on capital employed uses EBIT from the P&L against debt and equity from the balance sheet. Free cash flow yield takes free cash flow from the cash flow statement and pits it against the market cap. Why? Because management can easily manipulate one statement in a vacuum, but it is exponentially harder to fake the numbers when they have to balance perfectly across the P&L, the balance sheet, and the cash flow simultaneously. Section 5, your quick connection practice. All right, we've thoroughly covered the theory, the real-world numbers, and the new rules. Now, let's give you a highly practical mental checklist. Next time you open an annual report, I want you to run this exact 5-step test. Step 1, check the P&L profit. Step 2, jump straight to the balance sheet. Did retained earnings actually increase by that exact amount minus dividends? Step 3, go to the cash flow statement. Does your operating cash match the profit, giving you a clean cash conversion ratio? Step 4, look at CapEx versus depreciation. If CapEx is consistently higher, they are actually investing for true future growth. And Step 5, ensure the change in debt on the balance sheet perfectly matches the borrowing activities in the financing cash flow. If everything flows logically across those 5 steps, you've likely found a gold standard machine, just like TCS. It means the engine is running perfectly and management is being fully transparent with you. So I leave you with this. If you take this whiteboard knowledge and run this 5-step test on the biggest investments in your personal portfolio today, How do they actually hold up? Are the accounts truly clean, or is the profit just an illusion waiting to disappear? Keep asking the right questions, keep tracing the physical cash, and I'll see you in the next explainer.